to discuss this further, we're now being joined by Professor Suyash Bhatt, Director at AFTI, joining us live from Riyadh. Welcome to World Business Watch. My first question to you, of course, why are global investors increasingly attracted to Indian stock markets?
So, good morning. I believe there's a strong, China plus theory which started a couple of years back post-COVID. But now, increasingly, as more and more bad news comes out of China, whether it's about 3 to 4% growth in GDP, that's what IMF has projected for China for next 4 to 5 years, versus India having 6 to 7% growth for next 5 to 7 years. Plus, you have an aging population in China. There are their own set of problems that they're dealing with. There are in US, if you see, there are almost 30 China plus ETFs which are there, and due to the real estate sector going down with Evergrande and other sectors, 29% of the economy of China is dependent on real estate. All these problems basically are not going to go away overnight. And whereas on the other side, you have a young rising middle class with a young population, hardworking, educated, English speaking, and we have a strong consumption story as well playing on. All these are right, ingredients for a successful investment, and that's what is attracting more and more foreign investment. And now even more US funds are introducing minus China kind of ETFs, where India is a higher weightage, where more than 30% weightage is given to India, which is one of the reasons why funds are flowing more to India.
Mr. Bhatt, you touched upon it briefly. I wanted to request you to highlight the issues plaguing China's investment landscape a little more, if you can, please.
Sure. So over last 20 years, you would see that what China had was a growing capitalist kind of approach. Though it's a communist country, but post you also see that the interest rates have been higher. Inflation is controlled, and the biggest contributor to their sector was export before 20 years. But over the last 20 years, what they have done is they've tried to be more inward focused, and to beat recession, they kept on building more and more real estate. So there are a couple of evidence which are there where they have tried to make more than 30 to 40 cities, which are called as ghost cities, where there is no one living, and they have invested billions of dollars in creating hospitals, infrastructure, and everything. And all of this is basically coming back to haunt them. This was done to beat inflation, beat recession. And one way by which you could beat recession is by investing in infrastructure. So they've already made the road. So now what else can they make? So that's what they did. They made real estate and houses and townships. But now the problem is nobody wants to go and stay in those remote locations, because everyone wants to stay where they're working, near the coast, where these mega cities are being developed. So you have a bigger problem and a bigger challenge which is coming to bite them. And when you post-COVID, you have already seen the CHIPS Act being enacted. There are disinvestments from China, where nobody wants to rely on only one supplier, which is causing more and more money to be invested in other markets. Like, for example, Foxconn. Foxconn has a target to create close to 25% of the global iPhones manufactured in India by 2025, 2026. So that's a massive shift from what you're looking at, traditional investors would be looking at in China. And when all of this money comes, it's not just, maybe you may argue Foxconn is not listed, but when these people get employed, we're not talking about a few thousand people. Like a normal factory of Foxconn in China has 200,000 people working there. It's just a complete township. So imagine the kind of workforce that will be required if you scale up to 25% of manufacturing of mobile phones here, and the disposable income that they get, and so on and so forth. So it's like a trickle-down effect. And one thing that India is doing right over a period of time is building on infrastructure and ports, because what China did was you make great roads and great ports. So you make products and then ship it out, and that's what we need in India. And that's what we have been doing in last 10 years, building good infrastructure and also a good port infrastructure, which is critical for any economy to grow. So from a service-based economy, we're slowly now focusing more and more due to Make in India and a lot of other initiatives towards manufacturing, which actually is more sustainable because service, as you know, if something changes globally, maybe the way you program changes, maybe chat GPT, AI, any of these, big inventions come in, they can actually replace many of these service related jobs that you have. But when you talk about manufacturing, these are hard things. So even if you have an AI, you may automate it, but to a great extent, these are physical labor based jobs. So you would need
Yes.
that human intelligence, human, effort to sustain these roles.
Mr. Bhatt, now, as you rightly said, the port infrastructure of India, I would say it's among one of the many things that India is getting right at the moment. I wanted you to focus a little more on India here, sir. I wanted to understand from you, how can India keep up with its growth given that the outlook for most major economies isn't bright at the moment? How can India continue its growth story in such circumstances?
So that's an excellent question. The focus of India, even till date, it has never been like what China had. That become a global factory for the world. So we have a very strong consumption-based economy. So more inward-looking. So when you have such a huge demographic dividend, and when you have such a huge manufacturing and service-based economy, even if the globe goes for recession, you can be an inward-looking economy where the rising income of middle class would support your economy for next 2 to 3 years till the time the world sorts out its mess. And as of now, I think the government is doing the right thing. So 2 years back, when they cut the corporate tax, that was the right signal, which is why companies started coming in. Foreign companies are investing. Also, the new one of the biggest scope of from strategic perspective is manufacturing of chips. So you can see the government came up with a semiconductor policy where they're giving tax ops to companies to come and set up chip manufacturing here. And these are all right checkbox that the government is trying to tick. And we have again a very good monetary policy, no shock